Okay, welcome back. I hope you have been enjoying my online lecture, right? Hopefully, I'm getting used to it, right? So today, we're going to move on to the second derivative that we're going to talk about, right? So we're going to move away from the forward contract. Today, we're going to focus on future, right? The next derivative that we're going to talk about, future part 1. Right. So, future is also a contractual agreement between the buyer and the seller. Right. So, it's also about specifying an assets. Okay. For a future price. Okay. On a future date. Right. So you will fix the date. Right. So the difference we will talk about the differences between the forward contract and the future is the future is a standard, okay, highly standardized contract, right? In a way, you can say it's very similar to forward contract, but in a way, you can also say it's a highly standardized forward contract, right? But as we know that a forward contract is non-standard, right? It's very much personalized, customized. So, but in future contract, it's highly standard, okay, which means it's a standard product. So, which means it can be traded over the exchange, right? So everybody can buy because it's a standard item, right? So when it's a standard item, it's easily tradable on the exchange, right? So in fact, future markets has already started long time ago, more than 150 years ago, right? People are already using this future concept, right? Future market concept, where as long as people start growing crops, right? The farmers has been growing crops for centuries, right? And that's how they grow food for us, right? So the farmers, they grow crops, and you know when you grow crops, it takes a few months before you can finally harvest them and then sell those uh, those crops, right? Ready new crops for sale, right? So in between this time, like I say, you need to ensure some uh, you would love to fix the price. Okay, so supply can sometimes exceed the demand, and sometimes the demand can exceed the supply. So because of this, supply and demand changes fluctuate, and that also impact on the price. Right, the market price will fluctuate accordingly. Right, so it gives a reason why there's this future contract things come out, right? The farmer will want to hedge against their selling price, and even the whoever need the crops, like for example the bakery who make the cakes, they would also want to ensure that they have a fixed buying price for flour, for example. So they also want to hedge against the flour price, right? So there you have a buyer can hedge the price, a seller can also want to hedge the price, right? So there is this thing about buy and sell, right? So it's a buyer market as well as a seller market for a future contract. So now you can see as we get into globalizations, right? The future market is also becoming to coming to the global market, right? In the global area, where we are not talking about just agriculture. So the whole future concept, right, contract has already expanded more than just agriculture goods, right? It has also gone into, we have already seen the currency, the financial instruments, such as the treasury bonds and securities, right? So how does the exchange work? Okay, the future markets basically centralized at the central marketplace where the buyer and the seller, right, from all around the world, they will gather and they will bid for a certain price, they will offer for certain price. So there always this sometimes you see in the stock exchange the open cry system where people can freely bid for a certain price, and the other parties, whoever won the price, can also bid for it or offer the rate, they want, right? And now even more, you actually done it in the electronic manner, right? In the stock exchange dashboard, you will see a lot of price fluctuates. There will be people buying a certain volume. There will be seller who's selling at certain volume, right? So that's where they always state the price of the future to be paid at the time of delivery, right? Uh, so here you have a flowchart that essentially try to illustrate the stock exchange, right? So you can see there's a stock exchange, which is actually the centralized marketplace where the seller and the buyer will congregate to basically negotiate or even bid for the price. And sometimes either the buyer or the seller, they will have their agent or sometimes their broker, right? So essentially these are the middlemen who basically try to match make the buyer and the seller together, right? So that's the broker job, the middleman job. And in between, in the midst of doing that matchmaking, they will be paid some commissions, right? And then you have also got the clearing house in the stock exchange to basically ensure that settlement is done on a daily basis. We talked about this before, on a daily basis. Why on a daily basis? It's also daily settlements easier, and that actually reduce the credit risk, right? Credit risk. So people will not default on payment. So every day you settle, every day you settle. You don't wait like 1 month later, 2 months later. That's a bit long, right? And people can run away, and people can do all sorts of things if the time drag too long. So if you do settlement every day, the most you lose is a bit, so settlements is done every day. So that's the transactions that's going on in the future exchange. Right, here you have also basically a cutout from the newspaper. So you can see sometime in business time, you can see some of this future that's been traded, not just on those crops, right? You can also talk about these commodities such as the metal, petroleum, right? Copper, gold, right? You can see all the various the future dates, back in December, October, etc. What's the rate, etc. And also we also talk about the exchange rate, interest rate, futures, treasury bonds, notes, and quite a lot, right? So a lot of things is traded on the future, right? In the future market, okay, another difference between the future and the forward contract is in the future contract, usually before you can start doing a trading on future, right? They will require you to put an initial deposit, right, of a good faith, right? So you need to start off with some money, right? You need to put some sort like a deposit, right? But we call this the initial margin, right? That you have to put in, right? And this margin is actually used, okay? So it could be like before you can do future trading, right? You need to put $5,000, right? And they will use this $5,000, right? Even though you didn't do anything to it, but the moment you buy and sell or buy and trade on the future, any loss or gain will go into this pot of money, go, right? So if the money is being lost on the day, that will be basically deduct straight away from the margin itself, right? So just now I mentioned, it's a day-to-day settlements, okay? Whether it's a gain or loss, right? You make a loss, then they will take money from there. If you have any gain in the future ground, then they will actually credit money into your this margin account, right? So settlement every day, very good, and it's automatically done by the exchange. You don't have to do anything, right? So the exchange, the clearing house, will basically do all the settlements every day, right, for every gain or losses. So you can see that this Saxo trader, right, system, they have this. They also allow you to do equity, forex, trading, etc. So they have various different counter, bond, T bond, S&P 500, etc. So just now we already talked, right? So before you can start trading, there is usually a minimum amount, right, that you must deposit, right, before you can start trading. And this is what they call the initial margin, initial money margin, right, to start out with. And this initial margin you can take back on, right? If you decided that you want to don't want to play anymore, right? You want to withdraw from the future trading, right? The contract is liquidated, right? This whatever left in your initial margin will be refunded to you, right? Will be refunded to you. So plus or minus whatever gain that occur, right, during the span of your future trading. So unlike so who are the players in this future market? Right? Again, there's two parties, usually the buyer and the seller, or sometimes we also have the hedger and the speculator. Right? So hedger, we know whoever who want to actually secure a future price basically is for their own businesses to protect against their profitability, right? So in the hedger, it occurs in the short. Remember what is short? Short position is like selling, right? So when you do a short, usually what, right? When you do a short sell, usually we will anticipate a drop in price. Okay, whenever you do a short, when you do a long, means you anticipate the market is going up. The market price, the future market price is going up. So again, hedger is basically to protect. Short is basically to sell, and they usually anticipate there's a decline, right, in price. Same for the speculator, right? Right? If you are a speculator who just want to gain profit, right? Your main aim is to gain profit and not to take the commodity, right? Or use the commodity or the underlying asset that you are trading, right? A speculator is just there. They're not keen in those underlying assets. They are basically there to make profits, right? So they also have the same concept, right? If they think that the price is on the decline, okay, then they should do a lot of short, right? But when the price is going up, the market price is going up, then they should be doing a long, okay, long call or long forward or long future, right? So you can have a long forward, long future. In the US, future markets is regulated by commodity future trading commissions, right? So it's like a policeman, right? Like in Singapore, right? The monetary policies, all these are governed by the MES, right? Monetary Authority of Singapore. So they are the one who ensure that all this trading, okay, are in proper order, right? So you have a policeman to basically govern that all these future trading especially is legitimate, is right. Right, let's take a look at some examples of futures. Right, so for example, I think we all have this before, right? That's the most common household. Nowadays we have our cable TV, right? We subscribe to one of the cable TV either from Singtel or Mio TV or from uh, this StarHub, right? So we subscribe to a 2-year plan, for example. So that itself is actually a future contract because what you're doing is you're basically buying a 2 years contract where you fix with the telco company that you agreed to receive a number of channels on the cable TV, right? A product for the future dates, okay, to come, and you're going to pay a fixed amount of fees, right? So you pay a fixed fees for a number of future months that you're going to come, right? For the next 1-2 years, right? So basically what you have done is you enter into a future contract where you secure the price that you're going to pay, right? You secure the price that you get. So even when the next 2 years, if let's say the StarHub or Singtel decided to raise the price, raise the fees of the Mio TV or the cable TV, they you'll be safe, right? At least you have already fixed the price. So this is where people are fixing the price. So you can see this is like the common thing, right? All any one of us will have it. So we love to have a fix, but some people they don't want contract, right? Then they pay a irregular fees, right? So when the telco increase, if you don't have a contract, you don't have a 2 years contract or 1 year contract, then you are binded by the rise in the the TV price, right? TV fees. So in a way, if you enter into a future contract like this, you basically reduce the risk of having pay a higher fees later on. So this is just one common example where you use trading. Right. Another examples, for example, tradings of commodities. Okay, so do pay attention on some things. I mean, tutorial will be going through some of this calculation again. Lecture we have, and you definitely expect such question and such calculation in your exam. Right. So here we have the royal myth, right, where they basically sell, okay, wheat, okay, or royal myth. They basically buy wheat to make flour, right? So they buy from the farmer, right? And how much are they buying? They're buying like 50,000 of pesos of wheat, right? So this is like a peso of wheat, one peso. So we are talking about 50,000 pesos, so that they can make lots of flour, right? So that they can produce flour from the wheat. They produce the flour, and then somebody will buy the flour to make the cake, right? So you have this kind of industry manufacturing all coming together, right? The farmer coming together. So so what happened is now the requirement, they need to make a lot of flour, so they need the raw material from the wheat, so they are buying this, right, this amount, and they want to lock the price, right, so they are buying 50,000 pesos of wheat. So they can actually they want to fix the price, they can actually go to the exchange to buy, to look up for the contract if there's any standard contract, because these are quite common, buying whip, vessel or whip. So they actually got a future market, got a listing, like one future contract is cost 5k for 5k, okay, 5k 5,000 pesos, right? So if you need 50,000, which means what, this is only the listed is only 5k, so you need to buy 10 future contract, isn't it? Right, to make up for the 50k peso. Right, so this is on the stock exchange. You see which one you want to buy. So they list one future contract 5k, 10 future contract. Since you need 50k, so times 10. This is a 5k to 50k. You need to times 10. So you need actually 10 future contract. You need to buy 10 of this. Right. So let's say the value, okay, of the contract is $3 per peso, right? So which means what, you need 50, so 50 times 3, that is the value of the contract. That will cost you about 150k, right? 150k, 150k. So each contract guarantee a delivery of 5,000 pesos, right? And each peso value at $3, $3 per pesos. So um, so after some time, okay, the trading price might change, right? Let's take for example, if it dropped to 250, right? Let's say it dropped to 250. So there was from $3 to 250, there's a drop in 50 cent, just 50 cent. So let's see what's the impact, right? From $3 per peso drop to 250. So what is the total, right? So 50k times 2.5, right? Well, no, we don't time 2.5, we just calculate the differences, right? So 50k, since it dropped 50 cent, so we just straight away times 50 cent. So which means what? There's a drop of 25k, right? 25k. So what is the future positions of the royal, right? So if he were to buy this 10 future contract, okay, that will basically cost him 150k, right? That will cost him 150k. If the peso drop 50 cent, okay, what does it mean? It actually dropped to 125k, which is a drop of 25k, right? So there's a drop of 25k. So you can see the magnitude, right? Just a 50 cent drop, because they are buying a huge bundle, right? So what they can see is, they can see that their future contract, there's a drop, okay, because since they buy high and now they have to suffer the loss of 50 cent, so there's a loss of 25k, as much as 25k, right? So here is another scenario, same scenario, but instead of dropping, now what happens if it goes up by 50 cents, right? From $3 go up to 3.50. So again, just now lost 25. So if it go up by 50, then of course the future position actually gained by 25,000, which is not bad, right? So like I say, this kind of thing, 6 month time, nobody knows, right? So it can be win, it can be a loss, right? So it's up to you, right? So to take the risk, right? So that's what happened over here. But basically, the whole scenario would happen, turn out to be like the Royal Mint will basically still pay their regular supplier 350, right? At 350, which that's the market price, and altogether you're going to cost, right? 50 times this, you're going to cost the Royal that much. So how does the hedging takes place, right? He still pays so much to the supplier, 175. Though the issue is because he had got the future contract, right? And that future contract, since just now we already talked about, the now has risen by $3.50. So there is a profit of 25K, right? So you can see there's actually again same two transactions going on. So the sales transaction you go through and pay the regular supplier at the increased price at this value, right? So since he pay extra 25K, how does he contra off, right? Because of this extra gain that he got from trading the future, he got the 25. So that 25 will basically use it to compensate for the extra price that he has to pay. So 175 plus the gain, the future gains that he has, right, from trading the future from the exchange, he used the gain to make up for the extra cost that he has to pay for the whip, right? So now you see the thing, at the end of the day, because of this contra and having the future gain, so at the end, he basically managed to hedge his price at 150K, right? So you see the value of the future contract, future exchange, right? They make use of the gain and then they use that to hedge the price, which is what they want, which is hedging at this $3. So that will cost him the 150, right? So this is how they would contract, and in the way we have been saying is a hedging taking place. Right, so for every future contract, you can see that just now we saw, right, it always specified the quantity and the quality, right? So the quantity, how many peso that you're looking for, and also the price, and also the quality. Uh, so the underlying assets can actually be a physical goods, right? Just now we saw the crops, the whips, right? The flour. These are all physical goods. But again, in future, there's also the intangible or financial underlying, which is the trading of the securities, the bond, currency, etc. Right? So, in fact, you can take a look at the example. Let me just show you the website. If you can click on, you can see there's actually a few future trading example, right? Trading of S&P 500 future, right? And also the trading of the Dow Jones Index futures, right? So these are examples that's given from the website, right? So you can see the S&P when it's at how much and the value of position, right? Basically, it's the same thing, right? So what is on this website is basically covered over here, right? So let's just do a quick one to go through the this trading, right? Just now we trade on the physical goods. Now we're going to trade on the future indices. One example is the averaging of the stock market, Standard and Poor, right? So let's say the S&P 500, right? We want to look at this, okay, as bet on this S&P 500. So assuming that we have an initial margin, remember in the future trading, we need to keep an initial margin, right? We need to put a deposit. Let's say assuming $4,000 to begin in doing a future trading, right? In the forward, you don't have to have such a margin, but in future you have got this. So that's one of the differences. So buy S&P 500 at this value. So this is the index sees the index at 1,400, and the value of the contract, right, for this future contract is going to worth how much, right? So for every price is $50. Okay, price of the index times the index. So 50 times this, the price of the S&P, right? So that will give you the value. So the value of the contract, okay, for at this point is actually worth $70,000. Okay, and your value is this. So now that was the initial position, right? So what happened? Let's say S&P 500 fall, right? So from 1,400 it fell. Okay, fell down to 1,380. Right? So what happened to your value? So back to this $50 per price of a S&P. So now $50 times 1,400 initially. Now you have $50, right? This is the $50. Where's $50 times this? The value of the contract is 69,000. So from 70,000 become 69,000. So what's the difference? There's a drop in $1,000, which means that you lose $1,000. So what happened? Settlements is every day, right? So at the end of the day, if it's 69,000, the value of the contract worth 69. So they will, whether you're going to take it out or not, but they will just do the settlement. So they will take the 1,000 from where? From your margin. Now you see the margin coming in, $4,000 minus 1,000 become $3,000. Okay, so that will be your margin left. So after a few days, the S&P 500 rises, for example, and you decided that you want to close the position, right? So now it went up 1,400 plus 1,000, it went up by 20 cents. So you can times, and you find that it become a 71,000. Okay, so 71,000 versus just your initial 69, right? So what happened? There's an increase of 2,000, right? Now you decided to sell. Okay, so now you sell. So initially it was 69, right? Right, when you are at the margins 3,000, now it goes up to 71,000. So that's an increase. Your value of the contract has increased by $2,000. So which means what? The 2,000 will basically goes inside your margin, right? And since you're going to close position, you can actually draw out this 5,000, right? So you can see initially you start out with 4,000. Actually, it turned out not bad. You actually earn 1,000. Okay, but like I say, in between there will be settlements, and they will basically deduct the losses or profits. They will either debit from your margin or credit from your margin, right? So this is how the margin actually works, right? So trading of a Dow Jones Index. So now, just now was S&P 500. Same thing for Dow Jones Index is the same, right? But in this case, we take a little bit different approach where we now do a short sell. Okay, remember, short sales. We talk about short sell means you actually sell first, okay, and then you buy back later. And why do you do that? You always anticipate a drop in the market price, right? Market price. So let's take a quick one. So let's say we start off with sell. Now we are starting off with sell, right? Earlier here we start off with buy first, right? When you buy, then you need to sell off later, right? It's always like this, right? You buy, then you sell off to close the whole transactions. So now we begin with short sell, right? We sell first, okay, which is usually quite risky when you do a short sell, right? So if you are serious that you think that the Dow Jones Index is falling, so this is starting off at 12,000, right? Let's say 12,000, it fall down to, let's say this 11.9k, right? 11 no, so there's a drop, which is what correct in your anticipation, right? So if we have a value of the contract, okay, how do we calculate? Let's say the value of the contract is $5 per indices. So since it's 12,000, so 5 times 12 is give you the value of your position or the value of the future contract, right? So 60,000, right? 60,000. So your initial position, which is the margin, assuming it's 4,000, right? That's why we say here 4,000. So 60, okay, 60, right? So here we have when it dropped to this 11.9k, right? So what happened is 5 times 11.9k, that give you this. So this is the your buying price, right? So buying. So you sell, then you buy. So what does it mean? You buy low, right? You sell high. So actually there's a profit of 500, isn't it? Remember now we are actually doing a bit of reverse, right? We sell high, the value of the contract we sell at this, now we buy back at this, which is lower. So you actually profit, right? And the 500 profit goes to where? Goes to your position. So your final position will be 4,500. Okay, so if the Dow Jones Index moves the other way, right? Now it moves up, what will be your value of position? So again, you calculate the total value of the contract 61 versus this, right? So what happened? You actually lose 1,500. Okay, from here, you this is your you buy, right? You buy high and sell no here, right? So this was your initial position. That's where you buy and then you now sell, right? Because just now you sell, then buy, and then now you sell. So you're selling, okay, at a lousier price. No, sorry, you're buying. Sorry, here is buying. Now you buy. So now you're buying back. So there's a minus of 1,500. Okay, you lost. So you they'll minus off from your margin. So you can see in a typical stock and shares or any future trading, this is the kind of chart that you will see, right? Going up and down, down and up. Sometimes it's very difficult to see any pattern. Do you see any pattern over here? Right? And do you see any drastic drop like this? Right? This can happen, especially when you have very, very bad news, right? Either the chairman passed away or there's some corruption detected, right? Or like in this case, now we have our virus outbreak, right? COVID, and that also caused the whole market to plunge, right? That's why you can always see this deep plunge, right? And if you can't sell in time, you'll be in deep trouble, right? Sometimes it takes a long time for the market price to goes up, right? So there are a couple of similar example on this future trading, right? So we have seen the S&P 500 indexes, and we also seen the Dow Jones. Right now, we're also going to see another short sell. So now we also start off with short sell. Even for currencies, currency trading of currency futures, right? We also talk about that. So currency selling of euro dollars at this exchange rate, right? At this rate, which is 1.3, the value is let's say this is 1,200. 125,000 dollar per euro, right? So you times that's the total value, right? So you sell first, and then let's say what happens if it drop from 1.3, the euro drop to this, right? So which is satisfied your condition when the market drops. So rightfully you know you should gain up because you sell and you buy. And what's the total value that you buy back, right? So you buy at this and you sell at this. So you can see there's a difference of 1,255, 250, right? So again, whatever profit you have, it goes into your position 4,000 plus 1,250, right? From the difference here, right? The profit that you make, it goes inside here, right? And if it goes the other way, right, and similar things will happen, right? So you can see that now the value is here. So you buy, you buy, right? So this is where you buy, right? So you actually buy higher than the value, right? Now you buy higher than the value. So the differences will basically be trade off from your positions. So that's a euro future. Then this is on the gold. trading of gold. So there you can see that future not only just on the indices but also on tangible products such as raw materials like gold price, right? So you can actually buy gold, trade gold through this New York exchange, right, for 100 ounce and assuming this. So again, now instead of buy first, now sell first, now we do a buy first, right? So you can do either a short or buy. So when you do a buy, you anticipate the market to go up. So here we have the total 65,000, right? Value position still the same. So what happened if from 650 the gold price from 650 drop, okay, drop to 640. The total value 100. Okay, since we are talking about $100, 100 ounce of gold, right, for every dollar. So 100 ounce and this is 64,000. So the value of this whole contract is 64. So there's a drop. You buy high and you sell low. So there's a loss of 1,000. So which is minus of that 1,000 from your position. So same if it goes up, right, and you sell at this, right. So there is a gain of how much? Okay, from 66, 64, right? So you sell, right? You sell, right? Just here is 64. 64 you buy and you sell at 66. So there's a gain of 2,000. So the 2,000 goes inside here, right? So you can see in the past there's quite a few examples. So you take time and see whether you can absorb, right? We'll come back to some of these during the tutorial, right? So with some of these example given, right, extensive example where you can see there's actually 4 or 5 examples here. So I hope that will actually help you to understand the future trading mechanism. Okay, so with that, again, thank you very much for your time and blah blah blah. This is one of my living room. Right, so let me just switch over.